So you have got some money saved up and you are looking to get started with this investing thing, but you don't know how to get started, or maybe you heard it's risky and you don't want to lose all your money. No worries, because this video is the complete guide on how to start investing for beginners. I'll be breaking this down into 5 parts, so feel free to skip around. In part 1, I'll be covering why you should even invest your money. Part 2, what you should be investing in. Part 3, when you should start investing and how much you should invest. Then in part 4, I'll give you a quick tutorial on how to buy your first stock. And lastly, in part 5, we will look at when you should sell your stock. So let's not waste any time and let's jump into part 1, why you should invest your money. There are 2 reasons for this. And the first one is to combat inflation. Here, I have $50. How much do you think is worth next year? It's still $50 lah, duh. But what can you buy with this $50? Or what is effective value? That's the real question. Because thanks to inflation, prices go up every year. So even though this $50 note still looks the same next year, its buying power has actually gone down. So let's say I have $10,000 in savings. With an inflation rate of just 2.5%, after 5 years, the buying power of this $10,000 would have gone down to $8,838. Or in other words, I've lost over 10% of my buying power just by doing nothing with it. And the longer I do nothing, the more buying power I lose. All the way till 40 years later, when I'm finally ready to retire. That's when I realized I've lost more than 60% of my buying power. So that's decades of hard work gone due to inflation. That's why the best way to prevent this is to invest your money so that it can grow faster than inflation instead of it slowly shrinking over time. Reason number 2, you want to grow your money at a faster pace. Nowadays, many people park their cash in a high-yield savings account, earning around 3% a year. Sure, that's a lot better than stashing it in a Milo tin. But let's be honest, that money isn't growing fast enough. This is an uphill battle because not only do you have to work more just to earn enough to reach your financial goals, but inflation is also quietly eroding your money's value in the background. As Warren Buffett famously once said, if you don't find a way to make money while you sleep, you will work until you die. That's why investing is so important. It gives your money the potential to grow much faster over time while allowing it to work for you instead of you always working for your money. And that brings us to the next question. What should you be investing in? And how does this investing thing even magically grow your money in the first place? Now, there are many things that you can invest in, such as stocks, bonds, real estate, art collection, gold, and even crypto. But for most people, the most common way to invest is in stocks. That's because stocks are one of the simplest and most accessible ways to grow your money, and they have a proven track record of delivering strong returns over the long term. The reason as to why stocks go up over time is pretty simple. Take for example, Apple. Every year, Apple sells more iPhones, they launch new products, expand their services, and open more stores. As the company earns more and more money, they become more and more valuable. As a result, the stock price goes up as well. But which company should you invest in? Is it Google? Is it Netflix? How about Tesla or Coca-Cola? For most new investors, their first thought would be to just look for the top stocks and just invest in them. While you can certainly do that, that would actually be a bad strategy. That's because even the best companies don't stay winners forever. And a great example of that is Nokia. Back in 2007, Nokia owned over 50% of the phone market share. But fast forward to today, that number has dropped to less than 1%. And if you look at the share price, well, let's just say it hasn't been doing so great since then. Good companies come and go all the time. For example, back in the 1990s, the top companies were IBM, ExxonMobil, General Electric, Shell, Walmart, and AT&T. But by 2000, many of these companies had been replaced by names like Pfizer, Cisco, and Citigroup. Fast forward to today, this list looks completely different and is now dominated by tech giants like Apple, Microsoft, Amazon, and Nvidia. So the strategy of picking companies based on just how well they performed in the past may not be the best strategy. Instead, in order to do well in stock picking, you need to put in the hours to do your research. That means diving into financial statements, understanding the business model, evaluating its competitive edge, tracking industry trends, staying updated with market news, and the list goes on. For most average investors like you and I, we would be like, ain't nobody got time for that. In fact, there are many professionals whose full-time job is to do exactly this kind of analysis. And even then, they aren't able to get it right all the time. For example, this analyst from UBS has a success rate of 67%, this one 59%, this 62%, and this 55%. And to make things even tougher, a study found that over the past 90 years, less than 4% of the companies accounted for 100% of the wealth creation. In other words, 96% of the stocks either underperformed or lost money over the long term. So the odds are heavily stacked against average investors. But thankfully, you don't have to pick stocks, because there's this magical thing called Exchange Traded Fund, or ETF. Essentially, an ETF is an investment that holds a basket of stocks. For example, one of the most popular ETF in the world is the S&P 500 ETF. This holds the top 500 biggest companies in the US, and these are currently the top holdings. So Apple makes up 6.5% of it, Microsoft 6.1%, Nvidia 5.7%. You may be familiar with most of these companies, and if you scroll all the way down, you'll probably see names that you haven't even heard of, like what APA Corporation, Mohawk Industries, Caesars Entertainment, and so on. So when you invest in an ETF, you aren't just investing into one single company and pray that it does well. Instead, you are investing in all these companies, and this lets you spread out your investments across them, thereby helping you to diversify your risk. For example, when you invest $100 into a S&P 500 ETF, about $6.50 goes to Apple, $6.10 goes to Microsoft, $5.70 goes to Nvidia, all the way to 1 cent in APA Corporation. That way, even if 1 or 2 or even 10 stocks does badly, you won't lose all your money, because the rest of the stocks can help to mitigate the loss. For example, over the past 1 week, Microsoft dropped by 3.5%, Nvidia dropped by 5.6%, while Amazon dropped by 4.7%, and probably the worst of them all, United Health, which dropped by over 23%. However, there were also many other stocks that went up, such as Apple, which went up by 3%, Walmart 3%, and probably the best performing of them all, Lilly & Co., which shot up by 16%. Because of that, the S&P 500 had actually gone up by 0.5%, despite some of the stocks seeing huge losses. So that's one of the main benefits of investing in an ETF. It helps you to diversify your risk by spreading your investments across all these companies. But wait, there's more. Another huge benefit of ETFs is that it has this self-cleansing property. So what this does is that when a company does well and its stock rises, it takes up a larger portion of the ETF. In other words, the winners will naturally drive the returns of the ETF. On the flip side, if a company performs poorly and its stock price drops, its weight in the ETF will shrink as well. And if it keeps doing poorly, it will eventually get removed from the ETF altogether, only to be replaced by another better performing company. These self-cleansing mechanisms ensures that you are always invested in the stronger and better performing companies, all without you having to lift a finger. So that's how the S&P 500 is able to go up over the long term. Rather than just betting on one company to do well, you are actually betting on the ingenuity, innovation, and the continued advancement of the human race as a whole, which has been a rather good bet so far. In fact, in most years, more than half of the stocks underperform a simple S&P 500 ETF. Over 95% of actively managed funds underperform the S&P 500. That is also why Warren Buffett said that for most investors, whether you are an institutional or individual investor, you will find that the best way to invest is through an index fund. And those who follow this path are sure to beat the net returns of the great majority of investment professionals. Now, here are some of my personal favorite ETFs that you can look into. But just to be clear, these are just suggestions and not buy or sell recommendations. Whether these are suitable for you or not still depends on your risk tolerance, investment goals, and time horizon. Just want to put this big here in case you miss it. First, if you are interested in investing in the top 500 companies in the US, which is the S&P 500, you can consider CSPX or SPYL. These ETFs offer a good balance of stability and growth, making them suitable for long-term passive investors. They come with an expense ratio of 0.07% and 0.03% respectively. The expense ratio is just the percentage fee charged annually by the fund manager to manage the fund. You don't have to pay this separately. It's automatically deducted from your investment. As a rule of thumb, you want to look for ETFs that come with low fees, ideally under 0.5%. In this case, 0.07% and 0.03% are very affordable. Now, While the S&P 500 is a popular investment, given that it only holds US companies, it comes with a high country concentration risk. This means your performance could take a hit if the US economy runs into some trouble, or if some orange man decides to piss off every other country and they retaliate by targeting American companies. To reduce that risk, some investors might prefer to look at global diversification through an all-world ETF, such as VWRA or FWRA. These ETFs invest in the top companies not just from the US, but also from all around the world, such as Japan, UK, China, France, and more. This helps to spread out your risk geographically, because while US companies often dominate, there have been periods where international markets outperform the US. So VWRA and FWRA have an expense ratio of 0.22% and 0.15% respectively, which is also incredibly cheap. Last but not least, there's SCSG. This ETF is for investors who want to focus not just on US companies, but specifically on US growth companies. These are the companies that have the potential to grow revenue and profits at a much faster pace than the market average. And because of that, they tend to offer higher potential returns. However, in return, they also come with greater risk and volatility. Because of that, this ETF is more suitable for those with a higher risk tolerance and have a longer investment time horizon. SCSG has an expense ratio of 0.04%, which is rather cheap too. So now you generally know what you should be investing in. The next question is, when you should start investing? Unfortunately, there's no perfect time to start your investment journey. If you're investing when the market is going up, you risk buying stocks at overvalued prices, and you could see them drop below your buying price when the market corrects. On the other hand, if you invest when the market is going down, there's always a chance that it could fall even further. And if you try to time the market by waiting for it to drop a little more, you might end up waiting too long only for the market to recover. So there's no perfect time to start investing, and you should always start investing as soon as you can. However, before you invest, you need to make sure you have done these two things. First, pay off any high interest debts that you have. I consider anything above 7% as high interest debts. So this includes stuff like personal loan and credit card debt. By clearing this as soon as possible, it will be as though you are earning a guaranteed return of 7% or more, which is hard to beat with most investments. Second, save up at least 3 to 6 months worth of your monthly expenses as your emergency fund. This is to ensure that you have a financial safety net in case of an emergency, such as you accidentally kena accident lah, accidentally lose your job lah, or accidentally destroy your home. This emergency fund is there to financially help you out in those situations, so that you won't be forced to sell investments at a loss or your backside just to cover an emergency. Ideally, you want to keep your emergency fund in a high-yield savings account so that you can earn some decent interest while also having access to the money immediately if you ever need it. Now, once you have paid off all your high-interest debts and saved up your emergency funds, you are now ready to invest your money. But how much money you should start investing with? The good news is you don't need a large sum to begin. In fact, you could even start investing with as little as $5, because even the smallest amounts can grow significantly over time thanks to the magic of compounding. Instead, what matters more is that you start the habit of investing as early as possible. Then, once you get comfortable with investing and understand how it works, you can gradually increase the amounts as your income and confidence grow. However, you should also avoid investing the money that you know you need within the next 10 years. That's because the stock market can be volatile at times, and it is impossible to know for certain where the market will go in the short and medium term. For example, if you are saving up for your wedding next year, or your house down payment 2 years later, or your kids' education 5 years later, it's best to avoid putting that money into the stock market. Instead, you should park the money into much safer options, such as fixed deposits and government bonds, where there's almost no risk of losing your money. Next, let's talk about how you can actually invest your money. To buy a stock, you have to use a brokerage account. Depending on where you are from, there are many brokerage accounts which you can choose from. For example, in Singapore, where I'm from, we have options such as Interactive Brokers, Mumu, Weibo, Tiger Brokers, and more. All of them offer the same core functionalities, where you can deposit money, buy stocks, sell stocks, and withdraw your money. So you can just go with anyone which you feel comfortable with using. But if you are curious about their fees and what are some of the features that they offer, I've done a full broker comparison video. Personally, my main broker is Interactive Brokers, so I'll just use that to demo in this video. The reason I like using Interactive Brokers is because they have the lowest fees for many of the markets. They also allow me to trade the UK exchange, where you are able to find many of the ETFs that I've mentioned just now, such as CSPX and VWRA. So if you're interested in signing up to Interactive Brokers, or any of the other brokers for that matter, I will leave the links in the description below for you to sign up. Some of them are running a promotion for you to get some free gifts, which is a great way to kickstart your investing journey. Anyway, once you have signed up, you want to find your brokerage with some money, because no money, how to buy stocks? Once that is done, you are now ready to buy stocks. So let's say I want to buy Google, for example. At the search bar, I can just search for Google, open up the stock, then click on the buy button. For quantity, I can choose to either buy in amounts of shares or amounts of dollars. So let's try buying $100 worth of Google shares. Next, you will see a ton of order types. But as a beginner, you only need to know two of them, which are limit order and market order. Limit order allows you to specify what price you want to buy the stock at. If the stock reaches that price, you will get to buy the stock. As for market order, you will just buy the stock at whatever is the current market price. So, for example, if Google is currently at $170, market order will allow me to buy it at $170. For now, you can ignore all the other settings and just click on buy order. Check through to make sure everything is correct, then click submit buy order. And if the order is filled, congratulations, you are now an investor. Okay, just in case you need a full step-by-step guide on how to buy stocks, I've created tutorials for most of the brokers out there, so feel free to check them out. So after you have started investing, the next question is, when should I sell my stock? Now, one of the most common thoughts many people have is that they should sell the stocks after the stock has gone up, or worse, panic sell after the stock has gone down. But if you are a long-term investor, and if you know you are investing in a good stock, ideally, you will never ever want to sell a stock. That's because if you are investing in a high quality company or an ETF, they will tend to go up over the long term. You will have probably heard that the S&P 500 gives an average return of around 10% a year. While that sounds attractive, the truth is that the market doesn't just give a flat 10% every single year. Instead, over the past 100 years, there were only 6 years where the S&P 500 gave close to 10% returns. In most years, the S&P 500 either gave wildly higher returns or depressingly lower returns. However, looking at the S&P 500 annual return chart like this is actually quite misleading. That's because it hides the true picture of what is really happening within those years. Instead, this chart tells a much clearer picture. What it shows is that every year, no matter whether it ends in the green or red, the market has always experienced some sort of a drawdown in between. Take for example, the year 2009. That was the year the S&P 500 hit the bottom of the 08-09 crash and went on to deliver a 23% return. However, during that same year, it also saw a huge 28% drawdown. In fact, drawdowns are so common that on average, the markets would usually experience a 5% drawdown around 2 times a year. Then every 18 months or so, we would see a 10% correction. And roughly every 3 years, a more significant drawdown of 15% or more tends to occur. The last time the S&P 500 had seen any huge drawdowns was in 2022, which means the drawdown that we are experiencing right now is actually right on schedule. Also, while it is easy to just look at these drawdowns as just some numbers, sometimes we forget that behind every drawdown, there's always something to be worried about. For example, back in 2023, we saw multiple banks collapsing due to the high interest rates environment, and the fear at that time was that this could spark a broader financial crisis, similar to that of 2008. Then in 2022, Russia invaded Ukraine, and people were worried that this could escalate into a larger regional conflict, or even trigger a global war. Then, of course, in 2020, the pandemic brought the world to a standstill, and no one knows how long it will last. Then, of course, this includes the current drawdown, which happened because one man is threatening to end global free trade and the relative peace that came with it. If anything, history has shown us that the market is far more resilient and stronger than what we often give them credit for. Because not only has the market recovered from past crises, it has gone on to deliver great returns over the long term. So, realistically, how long should you hold your investments for? I would say at the minimum, your holding period should be at least 10 years. Here's why. This chart shows the annualized rolling returns of the S&P 500 all the way back to 1995. If you only held your investment for a single year, your returns could have ranged from a massive gain of 63% to a steep loss of 43%. But if you held your investments for at least 5 years, your annualized return would have ranged from a high of 25% to a much smaller loss of just -6%. That's because there were periods where the market crashed and took several years to recover. And if you had held on for 12 years or more, you wouldn't have experienced any losses at all during this time frame. In fact, the longer your holding period is, the more your returns will smooth out and converge towards the S&P 500's long-term average of around 10% per year. Most people think that the challenge when it comes to investing is choosing what to invest in, but that's actually the easy part. The biggest challenge is actually managing your own emotions and learning to see past your bias. This is called the behavior gap, where if you just did nothing, your investments would have given you this much return. But due to emotionally driven decisions, your actual returns could be lower. For example, from 2002 to 2021, the S&P 500 delivered an average return of 9.5%, but the average investor only achieved a 3.6% average return. That's why for most investors, the best method of investing is passive investing, where you just go with a well-diversified ETF and just set up regular investments to automatically invest. That's it. The simpler your investing strategy, the better it is for you, both in terms of your market returns and your mental well-being too. Because you already spend so much time and mental energy on your work and life, and investing shouldn't be another source of stress. But then, one fear many investors have is, what if my investment goes to zero? Now, if you are investing in individual stocks, the chances of that happening is very real. Companies can and do go bankrupt. But if you are investing into an ETF like the S&P 500, the odds of that happening are extremely low. The S&P 500 has gone through many terrible events throughout its lifetime, such as depressions, recessions, wars, pandemics, and countless other crises. And each time, it has managed to bounce back stronger. Now, of course, I'm not saying that there won't ever be an event that can cause the S&P 500 to go to zero. But in order for that to happen, something drastic has to happen, like all the companies in the US were destroyed, or a collapse of the financial system. But if that were to happen, you would have a much bigger problems to worry about besides money. So I would say the chances of this happening is probably like 0.0001%, which is highly unlikely. Or in short, don't worry lah. So there you have it. That was an ultimate guide on how to get started on investing. Hopefully you found it useful. If you have any questions, feel free to ask them in the comment section down below, and I will try to answer them. Like, share and subscribe, as I'll be posting new videos every week.